Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Joining me today is none other than Brad Everett. Hot Brad Everett, we call him.
Boy.
Yes, we just finished.
No, we don't.
Yeah,
We don't call him that.
Oh, my goodness. Well, here's the thing, you guys. So every time we do these podcasts, I am always freezing cold, and this guy's sweating his tail off. He's like, God, it's so hot in here. Well, I'm sorry,
It's
but
pretty warm in here.
yeah, I'm very comfortable, Brad. So it's the Patti Brennan Show, so suck it up.
That's right.
Right?
Perfect.
Okay, so anyway, the reason that we are talking today is, I like to hold ourselves accountable, right, Brad? And you and I talked in January and gave our year, our outlook for 2024. This is an opportunity for us to think about, okay, it is what it is. How do we do, and what do we think going forward? So it's kind of an accountability check,
Right. Yeah,
right?
sure.
Good deal.
Great.
So at the beginning of the year, everything was about the Fed, and everybody, including us, thought, oh, yeah, the Federal Reserve is going to cut interest rates this year. Well, here we are in June. Hasn't happened.
Not yet.
And we don't know if it is going to happen, right? Some people say it's going to happen in September. Other people say, no, they don't want that for the optics because of the election. I heard somebody today talk about the fact that they're going to increase interest rates in December because actually, yeah, inflation has gone down from 9.1%. It bottomed out at 3%, but guess what? It's ticked back up to 3.4%. And they don't want that, right?
Right.
So let's talk a little bit about where we are today and this concept of the Federal Reserve's influence on the economy and the three things that we talked about before. What's a hard landing, what's a soft landing, and what is no landing at all that we're hearing a lot about right now?
Yeah, I think that's the debate, right? And that's what we're all trying to anticipate and try to figure out what may happen. And so, and they're all really like, what is the ultimate result of the Fed raising rates to combat inflation? Mm-hmm. So I think you're right. Like there's three choices, right? And I think the concept comes down to something very similar to actually landing an airplane. A hard landing for an airplane is one that happens at very high speed, right? It's not technically considered a crash, I guess, because it probably lands on its wheels, but it's stressful. The plane may get damaged and passengers may get hurt. Right, mm-hmm. That's a hard landing in an airplane.
And to relate that back to the economy, the passengers that we're talking about are people, right? Yeah. People losing their jobs.
Exactly right.
Companies going under. Yeah. That's what tends to happen when there is a hard landing in an economy.
Yeah. Yep. So a hard landing in the economy is an extremely sharp slowdown, right? All those things happen quickly and severely, and it's probably from Fed intervention, right? They raise rates very rapidly, very high, and well, what if they raise them too rapidly and too high? The economy could contract all the way to a recession. Businesses would have to reduce their workforce, like you said. They might have trouble paying back debt. And then depending on the surrounding circumstances, it just happens so fast that there's nothing that a central bank can do to stop it. It seems kind of inevitable. So a more desirable, I think, outcome would be kind of this idea of a soft landing, right? In which case the central bank raised rates just slowly enough. You get inflation in range without sacrificing the jobs, creating the debt crisis. I don't think there's an official definition, but I guess a soft landing could end in a mild recession, but not a severe one. The definition changes depending on who you ask. There's no official, I don't think,
isn't that fun?
Definer. But I think
that's
why the Fed's job is tough, right? You don't know ahead of time what the correct exact pace is supposed to be. You're just trying to absorb as much data as you can and trying to adjust as you go. I think that's, it makes Jerome Powell's job a little bit difficult because
even the data that he's looking at, boy, there's so many opinions as to whether or not it's even accurate,
right,
or how it's being measured. Inflation, for example, housing is the third of that, of what goes into inflation. But it's not how much our homes increased in value. It's the owner's equivalent rent or something. I mean, it's very interesting how you think it's so technical and they know so much. And what I appreciate about their language is they're basically saying it's data dependent. They're kind of playing it by ear, right?
Yeah. There's a lot of things to consider, far more than that they even talk about when they address the public.
And the other thing I think that a lot of people don't realize is interest rates aren't the only thing that the Fed does to affect an economy. Maybe what they're doing behind the scenes right now, or what they've recently announced, okay, so they haven't cut interest rates, but they did announce the fact that, okay, this quantitative tightening or the quantitative easing, what they were doing is they were tightening, which in English means they're going to get rid of some of the bonds that they hold on their balance sheet, right? And because of that, the longer-term bonds are probably going to go down. It's kind of a way of providing liquidity in the market, right?
Yeah.
And liquidity is everything, right? We have liquidity, we're spending money, yada, yada, yada. Well, what they've announced is in June, they're going to cut the selling from $60 billion a month to 25. So they may not be cutting rates per se, but they are easing a bit.
Right.
Mm-hmm.
Yeah.
And that's something that will influence, and it's gotta work its way into the economy. It's not going to happen overnight, but it does work its way into the economy.
Yeah, kind of a slow process, and they don't know until later
Right.
how effective it was.
And that's the problem. They don't know until after the fact.
Yeah.
That's why this is so difficult to predict, and so many different things are going to influence it.
Which I think is probably also how you get in the position of raising too fast, right? Is because you're not waiting.
Right. Well, and
To know everything
and
you
I
need to know.
think that people who are listening today recognize that they really increased interest rates like crazy, fast, in a way they had never done before, because inflation shot up so quickly. And originally, it was after the pandemic, and the Federal Reserve's language, at least, was it's because of the supply chain problem, right? Well, supply chains started to open up, things started to flow, and it's supply and demand, right? So the supply started coming in, right? But the demand was still really hot, and inflation went nuts.
Yeah.
So as a result of that, they had to increase interest rates really quickly because they shot up to, close to 10%.
Yeah, and then, so they've really paused for a while, which would kind of lead to this third choice, which is the no landing scenario at all, right? Which the idea would be, without the Fed doing anything else from here, that inflation would drift kind of close enough to where they're comfortable, right? You solve most of the problem, but maybe not all of it. And then so you would have kind of sustained higher interest rates. Rates wouldn't drop or increase. More than likely, they would just wait and let inflation dissipate. But maybe it gets stuck somewhere higher than where they would prefer. But maybe they feel like they've done like 90% of what they wanted to do in terms of reducing inflation, but you still have an economy that's growing a little slowly. So you have this real, like, kind of at the end, last mile kind of trade-off where you're saying, how much do we care about getting rid of this last bit of inflation that we don't like? Are we willing to put the economy into a recession now, knowing that there's only a little bit we really wanted to do, or do we just let it stay higher?
And what's interesting about that concept is the way the market seems to be perceiving this higher for longer. And Brad, you and I didn't talk about this, but I went on Y charts today. Wow, look at this. In May of this year, stocks rebounded. NASDAQ went up 7% in a month, and the S&P 500 went up 4.5%. And in the last 12 months, as tough as 2022 was, if you just take, and this is another example of statistics and numbers, if we go year over year, okay, which takes it from May of last year to the end of May this year, the stock market has gone nuts, right? It's up, NASDAQ went up 30%, S&P 500 was in the high 20s, et cetera. I don't know about you. This one surprised me. What do you think the number one sector in the market? I'm going to put you on the spot because we didn't talk about this. What do you think the number one sector in the market was in the month of May?
In terms of, I'm sorry,
performance.
Energy. This is a
Good
weird guess.
No, that's actually a really good guess, because everybody thinks it's it's got to be technology, right? It's
Yeah.
got to be tech. Actually, it was utilities.
Yeah. Okay.
How's that? How's that for an argument for diversification and
Right.
not getting too cute? Utilities were up 9%.
Yeah.
In the last 12 months, again, tech. Actually, it wasn't tech that was the number one sector. It was actually financials and industrials did better than technology in the last 12 months.
Yeah.
Trailing 12 months, May to May. So it's very interesting how our perception and what we hear about doesn't always translate to, client statements, right?
Yeah.
And portfolios,
Yeah.
et cetera. So hard landing we get, soft landing we hope for, no landing is, okay. So it's, when you think about what we're hearing about no landing being more kind of, everybody's thinking, well, there's no reason for them to lower interest rates, right? Because we're inflation's kind of getting there. If they lower interest rates, then inflation could kick up again, and it's already kicking up a little bit. So they don't want to do that. If they increase interest rates, then they could push us into a recession. And by the way, we're already slowing. I mean, things are already kind of slowing down. The good news is unemployment is great. Last year in 2023, and I'm getting into the weeds here, but, the average monthly jobs number in 2023 was 250,000 jobs per month. That's really high, and it's continued this year. So we've never had a period of time in this country where the unemployment rate stayed at 4% or below this long since the 1960s. We are a consumer-based economy.
Mm-hmm.
If everybody's working and feeling warm and fuzzy, they're going out and spending money. And if they're spending money, then companies are making money, et cetera.
Yeah. Yes, I guess that maybe I would have a question for you. I think, and maybe to change the subject a little bit, but I think it may tie. So interest rates are higher, deficits obviously increasing. Are they related? One, like how related are they? And do you have any concern kind of about the strength of the economy, and currency from there?
That is a great question. And it's one that, the talking heads or people, in conferences, I just got back from a couple conferences, everybody's talking about this deficit and the impact of the higher interest rates. And what is that going to do to the United States as the, dominant economy? Because, we all know in the last, certainly the 5 years, 10 years, we diversify internationally, but you know what? The United States has been dominant. We have been growing when other countries have not. So what does that really mean? A rising deficit typically is not good for an economy. It affects our currency in a very negative way. At what point are we going to break that historical, whatever, that feeling that the United States is the only place to be?
Yeah, like the deficit to GDP figures or the debt to GDP figure. Yeah.
Exactly. And we've seen other nations. Look at Japan. Look at other nations. I mean, they've got real problems with their deficits and their debt.
Yeah, I would think. I guess from our perspective, it almost seems like the spending itself is going to be nearly impossible to solve, right? I mean, I think you can. I think politically, it's easy to say there's a lot of things that are wasteful, but in reality, there's only a few major categories of spending that would really cause a dent, right?
Yes.
In terms of the overall deficit, and I think there are things that no party would actually vote against.
Right.
Right. I think the military, Medicare, Medicaid, things like that.
Yep.
I just don't think either party would have the political will to
Certainly.
reduce the spending on those things in a way that's significant enough that you would even, notice that spending dropped.
Right, exactly. So what you're saying and what I'm hearing also is we're going to have deficits for a while here. And, at some point, some people say, if as long as the country, the GDP continues to grow, then we can service the debt and, higher interest rates will have an impact, but we're still okay, right? And that's the goal. get the economy to continue to grow, which again goes back to the Fed and goes back to policy. You know, we got an election coming around, and what's that going to do, et cetera. But for now, I think the biggest concern, of course, is Social Security and Medicare is a huge chunk of what the federal government spends money on.
Right.
And to your point, Brad, that is not something that is going to change anytime soon.
Yeah.
Neither party, neither candidate is even talking about it.
You wouldn't be able to campaign on cutting any of those
Nope.
things. Yeah.
Yeah, so it's not a popular thing, and they probably wouldn't get elected.
Right.
Okay, so let's talk about the markets and household net worth. I mean, we're at a point where household net worth in America is at an all-time high.
Yeah.
Consumer spending, et cetera. Let's talk about the economy in general and what we can expect or what we're thinking about going forward.
Sure. Well, I guess there's a lot there, right?
Yes.
So we're, I think, so a lot of the net worth, it's interesting, right? Because I think a lot of net worth is more a mindset, I think, than actual spendable cash, right? There's a lot of net worth in houses. There's a lot of net worth in retirement plans.
Exactly.
In reality, there's not a tremendous amount you can do about that. That doesn't, on a year-to-year basis, I don't know that will fund the economy. But long-term, that's great news, right?
It makes people feel more comfortable.
Right.
There's the wealth effect,
Consumer
right?
confidence is
Yeah, exactly. And they
is
go
through the
out and
roof
spend
still.
money. I think the key here is the unemployment rate and the fact that as long as people are working, they are spending money, and we are a consumer-based economy. Actually, there are two things to consider when it comes to employment. There's the labor supply, which basically, because of the pandemic, the labor supply crashed, right? There were companies who were screaming, we need workers, and they couldn't get enough help, right? Labor supply has actually improved tremendously, mostly because of immigration, because that seems to be a big reason why it's getting better. But the participation rate is still below where we were before the pandemic levels.
Okay, yeah.
And the
Right.
participation rate is basically because a lot of people are retiring,
Right.
right? So that's a factor. And when people, as we know, because we work with those people, they tend to be more worried about their spending because where am I going to get my income? Where's my salary coming in? And that might have an impact on the economy.
Yeah. Yeah, it just seems like there's such few things that actually influence GDP growth, right?
Yeah.
It's labor force. Can the labor force grow? So then you've got, it's like comes down to a demographic question, right? Can we replace workers faster than they retire?
Right.
And in reality, that like immigration is, part of that conversation too.
And if I can interject, Brad, it's not only can we replace the workers, but can we replace the people, right? So it's the immigration is fine, and that's a whole big issue. We won't get into that. But also, let's just talk about replacing people. What's happened over the last 70 years, for example, on a worldwide basis, the number of, babies being born has been cut in half. And, in today's environment, in the United States, or actually globally, it takes 2.1 babies per female to keep your population exactly the same. Well, in the U.S. today, we're not having as many babies. It's 1.7. Now,
It's a pretty big gap.
it's a big gap, and that's got important implications. So, especially for our future, on many different levels, we're not going to get into the weeds on that, but it is a factor in terms of GDP, right? And growth. And where's the growth going to come from if we don't have enough, as many people buying stuff?
Yeah, I mean that's the only other input is just productivity. So yeah, it's workforce and productivity is all that's.
I'm so glad that you brought that up because let's think about that. That's the big AI hype, right?
Right.
Productivity, right? That we're going to be able to do so much more in so much less time. And by the way, does that mean that half of the workforce is going to lose their job? I don't know. Robots are the big thing right now.
Yeah, I mean, I guess that can always happen in the short term, right? Until that that workforce is put to a different productive use, you can say like, well, it just frees them up to do something else instead. But until that person's trained to do a different job or is finds the right company that can use their skills. I mean, there's always some kind of frictional period there where a new technology could very well displace a lot of people. But that so far, in 2024, it's always happened that those people have again found some productive use, and the economy has needed them to do something else instead.
Yeah. Yeah, you weren't born then, but I got to tell you, this feels like the 1990s. Yes, you were born.
I was born in 1990.
Huh? No, were you born? All right, so you were 5. But anyway, it feels so much like the 1990s with the onset of the internet, and everybody was freaking out that it's going to replace all these jobs and our economy is going to go down, and just people learned how to do different stuff. New industries were created. Yeah. This thing called an iPhone came as a result, and the apps and et cetera. So artificial intelligence is just another dimension of that. People are predicting that it could actually be even more significant than the internet. I think it's interesting. Even internally, we're experimenting with it. It's pretty amazing.
Yeah.
And what is also interesting to me is already we're seeing industries and jobs popping up. For example, did you know that there is a new title called prompt engineer? It's somebody who knows how to use artificial intelligence, these, Chat GPT or whatever, and knows exactly how to frame the questions to get the answer.
Yeah, they're just better at asking questions, and we probably ask questions like we would a Google search engine or something. Yeah,
exactly. So that's very interesting. Okay, so this is the mid-year. It is what it is. Markets are doing just fine, thank you. We are in the middle of the year. We got 6 months left. What do we think about the rest of it?
Yeah, so it's interesting because I think it comes down to which of those landing scenarios, right? I think they don't have to. It doesn't have to be bad, right? The no landing scenario probably changes a few things, but it doesn't have to be terrible. Again, I think it's just so nuanced, right?
Yeah.
That it's even in any of these scenarios, there's things that would work and there's things that won't. So, like I guess maybe as an example, we fuss with the no landing scenario. Like, let's talk it through.
Okay.
If let's say there's no landing, inflation goes down a little bit, but that would suggest probably that rates stay higher for a longer period of time. I think probably how does that flow through?
I'm going to throw. Let's keep in mind as we kind of brainstorm this. Remember that people and markets don't react to things whether they are good or bad. It's are they going to get better or are they going to get worse?
Yeah. So I think.
Don't you think that? Sorry, I didn't mean to interrupt. And don't you think that to a certain extent, people sort of get used to these higher rates and they just go ahead and live their life and do what they're going to do?
Well, I think, like the no landing scenario is nothing probably really got that much better or that much worse.
Okay.
Right? Doesn't that kind of seem like that's what that one is? Like rates don't change much. We just kind of keep cruising. The economy's growing, but not that fast.
Right.
Yeah. So what does that look like for clients? If rates stay higher, probably doesn't mean a whole lot to short-term bonds, but you could imagine it, maybe rates on the longer end of the curve go up. And there's been maybe a push, like we've had a conversation with a lot of portfolio managers about, now being the time to add duration. And duration, it's been this time to add duration for, 6 months. If we get this no landing scenario, I don't think we would want that much duration, right? Like, so that's, kind of the way, how does this flow through to what we're trying to do for clients? And I think that's one of the things, like, I would tend to stay short, right? Until the prices adjust.
I'm so glad that you brought that up because we have so many people who come in here, want to talk to us, recommend us to your clients, et cetera, and they talk about their opinions and what they think is the right thing to do. And isn't that wonderful that you just brought that up? Because we may or may not agree, and we've got to understand what the goal is for each client. And duration is something that is really kind of important. It's not just maturity, right? Why don't you define what is duration, Brad?
Yeah, I think so. Duration is partially about maturity, but it's also like a way to kind of average out. So the maturity is not the only time you get money from a bond.
Right.
right? You also get money in 6 months from now. You get money in whatever, depending on how the bond's laid out, right? Maybe you get annual coupon payments. Maybe
Okay,
it's
got it.
6 months, whatever. Maybe you don't
Yeah.
get any coupon payments. It's just a
Mhm.
zero coupon bond. But duration is a measure of kind of the weighted average of when all these payments come in.
Got it.
And
Mhm.
I guess there's another complicating factor, like a floating rate debt, would really, if interest rates go up, the value at the end may go down, but your payments have gone up, so duration actually could be pretty short. But I think we're maybe getting too
Okay.
silly there.
Yeah.
But duration is a measure of like when all these payments come in. So you could actually have a portfolio with a very long duration bond, but if the coupon's high, the maturity could be long, but the duration actually could be much shorter.
Right.
And there's a lot of
Yeah.
ways to do that. So you're just less sensitive to interest rates.
Okay, so that's the bottom line is it's measuring the sensitivity of a bond to rising interest rates or lowering interest rates.
Yeah.
How much it fluctuates in price on that given day in that given month. So, for example, again, I like to use example. If you've got a bond that's got a duration of 5, if interest rates go up 1%, the price of that bond goes down by 5%,
Yeah,
right?
pretty good
So,
average, yeah.
Yeah. So now it's worth 95. However, you got to keep in mind that it's earning interest. If the interest that you're getting is 3, your total return for 12 months is about minus
You maybe
2.
lost 2%. Right?
Yeah, so it's not like it's crashing, that kind of thing. So duration is an important measure of the sensitivity of the price.
Yep.
Okay? And that's how we manage risk. We want to watch and be aware of that. You can go long. Why would you go long duration? What would you be thinking about if we did what those managers suggested that we should do? Let's go long on the duration. What happens?
You would by doing that, you would be hoping to so-called lock in to higher rates, right? If rates dropped, which again, that's a choice too, right? So and I guess that was the point in picking this no landing scenario. Really, there's 3 different scenarios that we obviously work through and we say, what happens if this happens? What happens if this happens? What happens if this happens? Is there anything that's a good idea across all 3?
Yes.
Is there anything that's a bad idea across all 3? Is there something that we should moderate and say, let's have a little bit of this and a little bit of that, just in case it's a great idea in this one, but a terrible idea in this one. So,
Beautiful.
Let's just make sure we don't totally screw it up.
Right.
But the idea of going long duration is the hope that either A, rates stay the same and you can just lock into this high coupon payment, or that rates actually would drop and then you would have the capital appreciation at the end.
Because just as the value of that bond went down 5%, you could get another 5% on top of the interest that you got for the year.
Right.
That's a pretty good. And I will tell you honestly and truly that in the last few months, all these conferences that are basically people are saying that's probably where the easy money is going to be made, is in a bond portfolio. And you and I both know people don't want to be investing in bonds because they didn't do what they're supposed to do, quote unquote, in 2022. Right? But that's why we have to take every day, every month, and understand what's happening, do that scenario that you just did to make sure that people are going to be okay no matter what happens.
Right.
Right?
Yeah.
All right, I'm going to add another flyer in here. Excuse me. Okay. So the market went up a lot in 2023, right? Earnings came in. People were surprised. The market was surprised because everybody thought, and I say everybody, the talking heads, the analysts, the traders, thought that earnings were going to get slaughtered because of the higher interest rates that these companies were having to pay. I think people sometimes forget, those traders sometimes forget that there are human beings that are kind of pretty smart and probably understood that earnings were going to be affected, and they made different decisions so that their earnings wouldn't be as affected. So in 2023, earnings didn't go down. They were flat, surprising everybody, and the market went up. Okay? Now, here we are in this no lowering of interest rates, et cetera, but we got one more thing that could affect what happens for the next 6 months, and that is this wonderful thing that happens in November.
I forgot about that, yeah.
Oh, yeah, let's forget about it, right? Everybody wants to forget about it. So, knowing what we know and knowing more importantly, knowing what we don't know, which I think is just everything. There's so many people who are over their skis and they're so confident. And that, I think, is where really big mistakes happen. But again, having said that, we got this election. We understand that, markets are going to do whatever they're going to do, right? And we know because of the election year podcast that we did earlier in the year that, on average, markets lose about 14%. They have a drawdown, and then they go back up. And by the end of the year, nobody knows what happened, right? In an election year, they tend to go down more, right? So here we are in June of 2024, and historically, which we always have to say is no guarantee of what you could expect in the future, it isn't working out that way.
Yeah.
Typically, the first half of the year isn't terrible in a year of the election. Well, I don't know about you, but 10% is pretty darn good.
Yeah.
Right? So we're not doing historically what we've always done. What do we do now?
Right. Nothing.
Very good.
I think like an election's a weird one, right? I think I think the volatility stems from maybe it's important to vote. Obviously, I don't know that it's important to vote based on what you think will happen to the stock market, given who gets elected. I think there's very little correlation there.
Excellent point. I think it's really important for us to really drive that home.
Yeah.
The President of the United States, historically at least, really didn't influence stock prices.
No, I think you're in the middle of a business cycle that goes 15 to 20 years. At best, you'll be the president for 8 years of that. You're just going to be kind of, sitting in the seat, watching it go down or watching it go up. And I think there's maybe other things that they should spend their time talking about. But it's an easy thing to take credit for, right? You come in and the market goes up and you can say it's because of you. And
I think it's so interesting that the perception out there, generally speaking, is that the markets do really well when a Republican is in office, and it doesn't do so well when a Democrat is in office. And it actually, historically at least, has been the opposite.
Yeah, but it's like also close enough that you would never make that bet, right? I mean, you would do yourself a real disservice if you took your money out during one party's being in office and left it in when the other one was. It wouldn't make any sense to operate that way.
And I think it's also so important when we talk about historical statistics, et cetera. There are not that many periods of an election year, et cetera.
There's only been so many elections.
Yeah, exactly.
You just don't have enough data.
I thought it was interesting. Hartford came out with a great statistic about markets 3 months ahead of time, from the 3 months ahead of the election to the election versus the 3 months after the election. The 3-month average return in that particular year was a whopping 1.5%. And then after the election, 3 months after, the rate of return, historically at least, was 5%. There were two major exceptions to that average. The first one was when Obama got elected in 2008. We were in the midst of a wicked financial crisis, and the market went down. And the other one, I think, is also really kind of important for us to keep in mind. Not that we're going to do anything, but it was in the year 2000 when Al Gore basically campaigned against George Bush.
Right.
And the election was contested, and it went to the Supreme Court. And from the date of the election to the date that the Supreme Court ruled that Bush won the election, the market plummeted. So nobody knows.
Yeah.
And given what's happening in our country today, let's pray to God that doesn't happen again.
Yeah. I think an election always leads to uncertainty. The market doesn't like it, and then as soon as you know who the president it's going to be, then everybody just starts buying again.
Lives their life.
Yeah.
Yep, exactly. So the takeaway from this, it's mid-year. This is our mid-year outlook. We don't know what's going to happen. What is the takeaway from this?
Yeah, I heard somebody at a Fidelity conference a few years back say the answer to every great question in investing is always, I don't know, when do you need the money? And I think once you know that, you can prepare your portfolio for all kinds of scenarios, right? We don't know what's going to happen. We can, I think you can arbitrarily assign probabilities to different things, or we can go through this scenario analysis and say these are the things that could possibly happen, but we may miss one. So once we have the client's plan and anybody's plan laid out, that gives us a lot more confidence to not worry so much about making macroeconomic calls and making bets on an election or bet on a direction of interest rates. We can prepare knowing, what asset classes make sense for that investor. And, we can kind of go from there. And that's a fundamental truth that, we hope will, last for forever.
Absolutely. Fantastic. So it's personal. Let's make sure that this is personal. There's rules of thumb out there. There's historical statistics, et cetera. It doesn't matter. What matters is what are you comfortable with and when are you going to need the money? Right? Thank you, Brad Everett, best Chief Investment Officer out there. And thanks to all of you for joining us. My name is Patti Brennan. We are Key Financial Wealth Management with wisdom and care. I really appreciate you joining us today. If you have any questions, go to our website at www.keyfinancialinc.com. Have a great day. Take care.